$75 billion. That's how much the Federal Reserve injected through its standing repo facility on December 31st, 2025. Not a scheduled operation, not routine. An emergency uptake where banks borrowed directly from the Fed at 3.75% on the last day of the year. The official explanation called it year-end liquidity management. Nothing to see here, but the standing repo facility had been sitting at zero for weeks. Banks don't pay 3.75% to the Fed unless they have no other choice, and they especially don't do it on New Year's Eve, unless something is already broken. This wasn't the first emergency injection that week. 6 days earlier, on December 26th, the Fed quietly delivered $17 billion to an unnamed institution. The day after Christmas, Federal Reserve disclosure rules classify the borrower's identity for 2 years. We won't know who until December 2027. Connect the timeline. $17 billion on December 26th. Then both numbers collapsed back toward zero on January 2nd as the immediate crisis passed. But here's what the Fed didn't mention. That $75 billion spike was the largest standing repo operation since the program was restructured in 2020. Larger than March 2020, and it happened at the exact moment COMEX silver inventories were being drained at a rate nobody had seen before. Between December 30th and January 3rd, over 47.6 million ounces of silver were claimed for delivery at COMEX. That represented more than 60% of total registered inventory. Not over a month, in 4 days. Registered inventory matters because these are the only ounces that can settle futures contracts. And in 4 days, more than half of it was claimed. The data is published. On November 29th, COMEX registered silver stood at 78.4 million ounces. By January 6th, it had collapsed to 30.8 million. A 60% decline in 5 weeks. But this wasn't just a December phenomenon. In April 2020, registered silver peaked at 185 million ounces. By January 2026, it sat below 31 million. That's an 83% decline over 5 years. What made this dangerous was the Shanghai connection. While COMEX inventories collapsed, physical premiums in Asia exploded. On January 22, COMEX March contracts closed at $72. Physical silver in Dubai was selling for $99. In Japan, dealers asking $130. That's an 80% premium over paper price. This decoupling had never happened before. Gold occasionally sees 5 to 10% premiums during squeezes, but a systematic 80% gap across multiple markets? That's a complete breakdown. Shanghai Gold Exchange data confirmed the stress. Physical premiums in China exceeded $8 per ounce above COMEX futures through late December. Chinese buyers offering $8 premiums, Indian buyers offering $5. These weren't retail investors. These were industrial users and large trading firms scrambling for supply. Here's why that mattered for banks. Major bullion banks provide the liquidity making COMEX function. They facilitate delivery, and they do it with significant leverage. When physical supply becomes scarce and delivery demands surge, these banks face a choice: deliver metal they don't have, buy it at premium prices, or request cash settlement. The December CFTC bank participation report showed U.S. banks held a net short position of 81,000 silver contracts. That's 405 million ounces sold short. When registered inventory sits at 30 million and physical premiums hit 80%, that position becomes expensive to maintain. This is where the Fed's operations connect to silver. Banks providing commodity liquidity also participate in overnight funding markets. When you're holding large shorts in a commodity experiencing a supply squeeze and facing year-end settlement demands, you need cash immediately. SOFR data captured the stress. On December 31st, it spiked to 3.87%. Some repo transactions cleared at 4%. Well above the Fed's target range. Cash was tight enough that borrowers paid above normal rates. The standing repo facility exists for this scenario. Banks borrowed $75 billion on December 31st because repo rates would have spiked higher without Fed intervention. But what matters is December 26th. That $17 billion wasn't year-end window dressing. It was emergency injection to a specific institution under stress. Right in the middle of the December silver delivery period, the math is straightforward. If you're short hundreds of millions of ounces and delivery requests hit records and physical premiums explode, you need immediate liquidity. You go to the Fed, the sequence mattered. Emergency injection, December 26th. Record deliveries through end of December, massive injection, December 31st. Then everything unwinds January 2nd. But the silver stress wasn't just year-end settlements. Something structural shifted. China. On January 1st, 2026, China implemented export restrictions on silver, not an outright ban, but licensing that effectively functions as one. Only 44 state-approved companies can export. Those companies must produce 80 tons annually and maintain 30 million in credit lines. Most Chinese refiners don't qualify. The result is a de facto constraint on 60 to 70% of global refined supply. China announced this in October. The market had months to prepare, but preparation doesn't create physical silver. It creates front-run. Chinese exporters rushed deliveries before restrictions hit. China recorded record exports over 660 tons in October. Buyers pulled forward supply. That surge temporarily alleviated COMEX and LBMA pressure, but everyone knew it was temporary. Once January 1st hit, that flow stopped, and China's domestic solar and electronics demand would keep every ounce inside Chinese borders. The implications cascaded. Silver isn't just monetary metal. It's industrial, with inelastic demand. Solar panels require silver paste. Electronics need it for components. Semiconductors use it in bonding. China dominates solar manufacturing. When China restricts exports, Chinese manufacturers get priority, while Western competitors face shortages and premiums. The U.S. designated silver as critical mineral in November 2025. That designation came too late. U.S. production declining for years. There's no surge of new supply coming. Mine production is inelastic short-term. Perfect storm. Industrial buyers knew Chinese exports would stop. January 1st. They needed physical supply before that deadline. Financial players short paper silver faced delivering into markets where physical premiums exploded, and COMEX delivery requests, once made, couldn't be unwound. Shanghai pricing reflected the new reality. By early January, physical silver trading at $8 premiums over COMEX. That's not temporary dislocation. That's a separate market forming. Paper price in New York and London, physical price in Asia, no longer the same market. For banks caught in the middle, impossible situation. Contractually obligated to deliver at $72, but only available supply, trading at 50 to 80% premiums. Sourced from London or COMEX stocks, but those inventories draining. Negotiate cash settlements, but counterparty must agree, or go to the Fed and borrow emergency cash. December bank participation report revealed banks were covering shorts. Between September and December, as silver rallied from 41 to above 60, net short position decreased, but they couldn't eliminate it entirely. They remained short into December delivery. Reports circulated about JP Morgan specifically. Multiple sources claimed the bank exited its short position and flipped net long, accumulating 750 million ounces, allegedly unwound, 200 million ounce paper short between June and October, not confirmed by JP Morgan or CFTC, but trading pattern consistent with major player reducing exposure. CME responded with margin hikes twice. Initial requirement, around 22,000 per contract. January 3rd, raised to 25,400. January 7th raised again to 32,500. 47% increase in 1 week. Silver prices touched above 83 in early January, then pulled back to mid-70s. Margin increases forced liquidation, but physical premiums remained elevated. Gap between COMEX futures and Asian physical stayed wide. Sell-off in futures market, while physical demand, robust, markets disconnected. JP Morgan, Bank of America, Goldman, all published notes acknowledging structural changes. JP Morgan raised silver forecast to $56 average for 20. These weren't fringe voices. Mainstream banks acknowledging fundamentals changed. What mainstream missed was systemic risk. COMEX trades 300 times more paper than physical inventory. That leverage works in stable conditions, breaks when delivery demands surge, and supply contracts simultaneously. The Fed doesn't care about silver price. It cares about bank funding and solvency. When commodity positions create funding stress requiring emergency liquidity, that gets attention. 17 billion December 26th and 75 billion December 31st weren't about silver specifically. They were responses to dysfunction in bank funding, coinciding with commodity derivative stress. Official explanation focused on seasonal effects. But December 26th doesn't fit that narrative. Too early for year-end window dressing. No special reason for emergency funding, unless idiosyncratic stress, something specific to positions.
The timing suggests commodity-related stress, emergency cash. December 26th, record silver deliveries, another injection December 31st, physical premiums at 80%, market bifurcating, smart money repositioned for months, decrease in bank shorts, reports of reduced derivative exposure, surge in ETF inflows, rush to take COMEX delivery. These weren't retail panicking, informed participants reading supply data. Silver's move more explosive than gold because it started from suppressed base. Gold-silver ratio compressed from above 90 to around 55, 144% gain in 2025, best year since 1979. Just beginning of repricing, reflecting investment demand and supply constraints. What happens next depends on uncertain variables. Can COMEX function with inventory this low? Will more participants demand delivery? Will paper physical gap widen? Can Western supply offset Chinese restrictions? Fed's balance sheet provides one clue. After ending QT December 1st, gradual expansion began. Not large QE, but smaller operations and natural growth. December FOMC minutes noted 1/3 of respondents expected restart of asset purchases. Average expectation roughly $220 billion over 12 months. More liquidity doesn't affect physical supply, but it affects bank funding and hard asset attractiveness. When Fed expands balance sheet and keeps rates below inflation, supportive for gold and silver. When physical supply constrained simultaneously, effect amplified. Chinese restrictions aren't going away. Licensing through 2027 minimum, 44 companies controlling all exports. Part of broader strategy around critical materials. Western policies take years to implement. New mining capacity 5 to 10 years. Supply deficit exists now. Solutions years away. This environment created December crisis, physical supply contracting, industrial demand inelastic, financial markets discovering leverage, works both ways, banks facing delivery obligations they couldn't meet, emergency Fed liquidity preventing default, price signals distorted as markets diverged. 75 billion December 31st was visible symptom. Underlying condition is commodity structure, assuming physical supply would satisfy paper claims. That assumption no longer holds. Data suggests worsening. COMEX inventory near historic lows. Chinese exports stopped. Physical premiums persistent. Banks less willing to provide short liquidity. Margins rising. System adjusting. But adjustment painful and outcome uncertain. Immediate crisis past. Repo operations unwound. Markets functioning. But registered inventory at 30 million ounces. Daily volume regularly exceeds 50,000 contracts. 250 million ounces. Paper trading backed by 30 million physical, leverage, 8 to 1. One more delivery surge, and December repeats. The market is telling you something. Watch inventory data. Watch physical premiums. Watch Fed repo operations. 75 billion doesn't deploy on New Year's Eve for routine adjustments. 17 billion doesn't go to unnamed institutions. December 26th, without reason. Physical silver doesn't trade at 80% premiums, without structural dislocation. The fractures are visible. Whether they widen or get papered over with liquidity remains to be seen. What's certain is assumptions governing commodity markets no longer apply. Physical supply matters again. Delivery obligations matter again. When banks can't meet obligations without Fed intervention, everyone should pay attention. This story isn't over. December crisis was Act 1. What comes next depends on whether physical supply improves or deteriorates. Right now, every indicator suggests deterioration, and the next delivery period is already approaching.